Well, from public markets to private markets, let's turn there where Searchlight Capital founding partner Oliver Hartman is saying that staying optimistic rather that the market will pick back up after years of slower deals. Yet there is something else that could create opportunity. He says we anticipate the greatest source of deals in the market coming from when the wall of debt maturities comes due. Oliver joins us now. Oliver, thank you so much for coming in the studio. It is great to see you this morning.
Thank you. Good morning.
So I know you see a lot of opportunities coming from this maturity wall, but I want to know about the other side of things. For those that need to refinance into higher rates, talk about the scale of distress and trouble that is potentially brewing for those companies.
Well, I mean, potentially there's hundreds of billions of debt that's coming up for refinancing over the next 3 years. A lot of that is, we know there were so many acquisitions made in the 2017, 18, 19 period, at high valuation levels, but also very low interest rates. So people really were able to take on a lot of leverage to drive equity returns. And of course, it always feels scary when you're sitting as an equity holder and there's a lot of debt coming due, and you say, wow, maybe I bought this company for 10 times EBITDA, and maybe I borrowed 6 times EBITDA to fund it and put in 4 times of equity. And now I can only afford to borrow 4 times. So it's kind of scary. What do you do? I think that's related to the corporate world, but also to people's personal lives, whether it's a credit card debt or a mortgage.
So true. Okay, so when we get to that point, right, and everyone's dealing with this kind of scary atmosphere, we've been talking a lot about how the idea of there's this mismatch between buyers and sellers, that buyers want something lower, sellers aren't willing to sell at those levels.
Yeah.
Is this what brings the gap down?
It does help bring it down a little bit because you have to act. So if you're staring at that example that I just gave, and you can only afford to maybe borrow 4 times, what are you going to do? You're going to have to take action. And either you're going to sell assets. So, we are starting to see some deals where companies are selling assets and they use the proceeds to reduce their debt and then they can refinance the remainder. Or you raise equity. Obviously, you can always raise equity through an IPO. We know that's challenging. So there's other equity offerings that are possible, which we can talk about. And last, there's also going to drive some mergers because it might make sense to merge with a competitor, take the combined synergies of the combined company, and then refinance the combined debt at a more attractive basis.
Well, what is gaining traction at the moment? And I'm going to bring you some headlines from the Bank of England. We can talk about these. These are literally just crossing the Bloomberg terminal as we speak right now, which is that more private equities are struggling. The Bank of England warns that private equity exposed to tighter financing, as Danny has said. So again, this is their report that they produced. They talk about the stability report. It's the financial stability report. Would you agree that we are in a struggling mode and that we may see some king's crowns fall in that struggle? Are we going to see some?
Yeah, each deal is individual, right? So each firm is going to have deals falling into lots of different categories. And of course, there's the companies who are struggling to refinance their debt because they're underperforming their initial business plan. And those companies will have a harder time. They will obviously have to restructure, and the underlying equity owners will probably have to take some form of a haircut.
Right.
We've actually done some really interesting deals recently in good businesses that are still facing the refinancing wall because they need cash flow to reinvest in their business to grow. So in that example that I gave, you might be able to actually refinance at 6, be able to afford refinancing at 6 times, but you don't want to because your business is growing and you want to reinvest your cash flow in the business. And those can be really interesting opportunities where you're helping a business right-size its capital structure and effectively maintain the flexibility to keep growing, either organically or through M&A.
I mean, it is interesting, this kind of confluence of factors, because on one hand, you have maybe some companies that are exposed to these tighter financial conditions and are kind of struggling, yet there is a lot of money in private debt right now chasing assets. And you get this weird thing happening where some of these companies are doing strange restructurings. Vista Partners was one of them that did it recently. And still money is willing to be put to go to work. So with a lot of money and a deteriorating kind of atmosphere, do you see sort of bad behaviors picking up, this lender-on-lender violence, or maybe more risky things, taking out more leverage? Is it sort of fueling some of the risk-taking that maybe shouldn't be happening?
Well, I'm not sure it's risk-taking, but people will certainly get creative in terms of how they can capitalize their businesses, and there's going to be ways of doing it, within the existing credit stack, and coming up with clever ways to potentially put more capital into the balance sheet that actually might be less favorable to existing lenders. There's always going to be smart lawyers and private equity technicians who figure out interesting loopholes to create more capital.
But again, you know, just to drive home the point, I wonder within that if that's a troubling turn, that you're starting to see these lenders pushing people down the capital stack and willing to go above them. And again, this sort of lender-on-lender violence, as it's called.
Yeah, I think, look, it's a market. I think it's a clear market. The market clears at certain places. I think there will be some behavior that's challenged in courts, but there's also some of it that's just an evolution of the markets, and people adjust and adapt. And future credit agreements will be amended to adjust those things. You know, I want to come back to a big opportunity that we're seeing, which is really in preferred equity. So one of the interesting things that we've been doing is in these growth companies, let's say they do have 6 turns of debt, can only afford 4, we've been putting in 2 turns of preferred equity. We think those are really interesting risk-adjusted securities because on the one hand, the company is right-sized. It has a more affordable stack of debt and it continue to grow. And we get a very nice low to mid-teens type core return on our preferred equity. Plus, we have usually some equity upside through warrants, options, you know, other abilities to participate in future upside. And we're downside protected because we only have 4 turns of debt above us.
So you're protected all the way, but what about the investors which are looking for exits and they're simply not there at the moment? I just wondered, is that imaginative structure of financing that you're creating and putting in there, which keeps the businesses alive, but does it extend the IPO much further into the long grass? The traditional exit, is that what you're doing? You're giving yourself time and breathing space to face a better market in a better day.
Exactly. That's definitely true. We are starting to see, obviously the IPO market has been driven by just sexy mega cap large tech opportunities, right? Which is not applicable to most businesses. We have started to see trade buyers, strategic buyers start to come back. So we have over the last 6 months have actually had interesting approaches from strategic buyers for our assets. I think they often might be smelling an opportunity that private equity is motivated to sell, and maybe there's a deal to be struck.
Are you motivated to sell? Are these bids? Where are these bids coming through? Which sectors?
Well, we recently struck one with a trade buyer last fall that was a good, very strong, 2.5 times return for us in little over 2 years. So some of these are good, attractive returns that you're generating, especially if the strategic buyer thinks you have an attractive asset that's going to enhance their business and create synergy value for them, so they can afford to pay you. So we're not taking discounts on these deals.
Right.
But you have to own good assets. It all comes down to owning, good businesses at the end of the day.
Just quickly, Oliver, I mean, and this sort of applies to what Manus is talking about there being a lack of IPOs and only the sexy mega cap companies, as you say, are getting bids. Is a lot of this market underloved and prime for you to come into public markets to take private?
Yes. Take privates have been a massive opportunity for us as a firm, but I think for private equity more broadly. We've done, just in the last 9 months, we've completed 2 in the UK and we have 1 underway in the US. There's a lot of companies with less than, call it, 3-4 billion of market cap that are just ignored by the market. There's not enough institutional interest in them. Then the banks stop writing research. Then there's even less interest. The shares are very illiquid. And if you come in with a nice premium, it can be very attractive to the board, to the shareholders, and frankly, the management. Management often feels in those businesses they'd actually rather be driven by private equity ownership because we take a 5-year view. We have a clear strategy. They talk to one set of investors.
Are you giving out equity to the employees? There's a few other people. But is that a big part of it?
Yes, there's compensation benefits to it, and also less disclosure on the compensation, which is a positive thing in some instances.
You want to tell us who you're looking at?
Oh, I can't talk about that. I can't talk about that.
I thought we just go in for the last kind of.
Yeah, no, I can't do that.
Fair enough.
Yeah,
Oliver,
I would get in a lot of trouble if I did that.
Okay, well, we'll put you out of your misery. Oliver, thank you so much for joining. We really appreciate your time this morning. That is Oliver Harman of Searchlight Capital Partners.